Welcome to the first of Treasury Strategies' 4 2015 quarterly cash briefings for the UK, Eurozone, and North America. I'm Moni Lindsay, Managing Director in Treasury Strategies' London office, and I'm joined on this call by Tony Carfang, Partner of Treasury Strategies. We are pleased today to be joined by our panel, whose organizations are also sponsoring this event, Peter Matza from the Association of Corporate Treasurers, Debbie Cunningham from Federated Investors, Roger Merritt from Fitch Ratings. We'll provide further background on our panelists before the panel discussion. We're excited about today's briefing. As in past briefings, we'll share with you the latest reports from the central banks on corporate deposit levels, as well as findings and insights from our latest corporate survey. Also, we'll be discussing key game changers with our panelists to hear their views on the implications for you and for the market. There's some interesting additions to the game changers, including oil, now at $50 a barrel and talk of $40, and renewed rumors of Greece exiting the euro. We'll discuss the euro-dollar disconnect, continue our discussion of the impact of the liquidity coverage ratio, and interestingly, we'll note a renewed round of cash bashing. A quick preview of the next 45 minutes. Covering the topics just discussed. Tony will share the latest reported cash levels. I'll review the findings and insights from our latest corporate survey. Tony will then review game changers and facilitate the panel discussion, and then I'll wrap up. Please type your questions into the question box in the bottom right-hand corner of your screen, either during or at the end of the webinar. We would like to take the time to thoroughly and thoughtfully respond to your questions, and we'll be getting back to you with our written responses in the next few days. We'll circulate the answers to all who have called in. One more quick word before we get started. Please join Treasury Strategies on Wednesday, January 28th for our 9th annual State of the Treasury Profession. Each year we draw from our deep experience with corporates and financial institutions to assess where Treasury is headed. This year's theme is Carpe Diem. So Tony, what are the latest reports from the central banks telling us?
Well, thank you, Moni. We actually have quite a bit going on in terms of corporate cash levels. On the next slide, we actually have the graphs from 4 different regions, the US, UK, Eurozone, and Japan. It's interesting. If we start at the top left, we see that corporate cash in the U.S. at about 1.8 trillion there has been relatively flat for the last 3 quarters, which kind of coincides with the end of, or the beginning of the tapering, at least, of the Federal Reserve's quantitative easing. It's not entirely clear that there's a one-to-one correspondence between the Fed's quantitative easing and money ending up on U.S. corporate balance sheets. That's a hypothesis that we'll certainly be able to evaluate over the next couple of quarters, particularly now that the easing has completely ended. However, if we look to the right here at the UK, we actually see corporate cash continuing to increase, now reaching about 550 billion pounds. We don't see the same level of abatement as we saw in the U.S., yet as you're going to see later, the Bank of England balance sheet is not growing in terms of size, so the factors impacting cash in the U.K. might be a little bit different. In the Eurozone, corporate cash, although it had an uptick at the end of 2013, has been relatively flat for 4 years. So we do have some sort of disconnect, or at least different behaviors or factors going on. Curiously, if you look at the legend on this chart, you see the Eurozone numbers only go through the first quarter of 2014, whereas the others go through the third quarter, the most recent quarter that the central banks report. There seems to be something afoot in terms of adjusting and revising the way the Eurozone is actually reporting the cash items. Many of you may recall about 2 or 3 years ago, after we started reporting these numbers and reporting statistics about particularly cash as a percentage of overall GDP, some of the central banks began to take a look, and the U.S. Fed did a substantial revision in corporate cash, and in fact, they were reporting numbers up in the order of 2.2, 2.3 trillion, and then lo and behold, one quarter, a $500 billion corporate cash vanishes. It was simply a restatement of the way the Fed went back and recomputed and adjusted the entire time series. A year ago, the UK did the same, and it seems like now the European Central Bank may be doing something similar. It'd be interesting to see what they come up with. It's been difficult getting that information. The bottom right quadrant, as reported by the Bank of Japan, Japanese corporate cash is skyrocketing. I mean, it's moving up at an incredible pace, and you're going to see on the later chart the quantitative easing that's going on in Japan, or the stimulus that's going on in Japan, seems to parallel that growth. If we go on to the next chart and we look at cash levels as a percentage of the GDP within each of those countries or regions, what we see is the current September 14 cash levels. Corporate cash in the U.S. is at 11% of GDP, which is a whole lot higher from the 9% it was in September of 2000. The Eurozone at 21% has been fairly flat. Cash has been flat, GDP has been flat. The UK at 34% is the same as it was the prior quarter. The only increase actually is Japan, which has moved from 49% of GDP to 50% of GDP. And I think behind this, it's useful to see what the central banks in each of those regions are doing. So on the next slide, what we see here are the total reserves that banks are holding in each country or each region at that region's central bank. So again, beginning at the top left, the U.S. Federal Reserve in the year-end 2008, immediately after the financial crisis, really began to balloon its balance sheet. Banks had literally $40 billion of reserves, and that number had been flat for years and years and years, holding $40 billion of reserves at the U.S. Federal Reserve, and that number is now 2.7, 2.8 trillion. It's just been a huge explosion there. And once the quantitative easing, though, started to taper, you can see in the upper right-hand corner of that upper left-hand graph, we see the rate of increase decreasing, and we assumed that was a result of tapering, and I think correctly so. But if we look at what happened in the September quarter in September, it began to tick back upward at a more accelerated rate. And I'd like to make a comment about that. For those of you who attended last quarter's webinar, we talked about the recycling of the European stimulus, and we used a flow of funds analysis to show how basically $1 trillion worth of European stimulus was recycled through global banks and onto the balance sheet of the U.S. Federal Reserve because of the differences in overnight rates from one jurisdiction to the other, where the ECB was actually charging a penalty, whereas the U.S. Fed was paying a rate. Curiously enough, in September is when the ECB lowered its overnight rate to minus 20 basis points. So they increased the penalty, and lo and behold, we see an uptick in balances at the U.S. Federal Reserve. I think that simply provides more evidence to support the hypothesis that we put out last quarter. Reserves at the Bank of England have been very stable. Reserves at the ECB on the bottom left are barely above, well, in fact, they're even or below their 2009 levels. So what all the other economies in the world have stimulated following the financial crisis, you see this huge acceleration in 2012 in terms of bank reserves at the ECB, and then it completely reversed. And so we now hear about talk about ECB stimulus, ECB quantitative easing, or whatever. But we've heard that now for several quarters, and as you can see, that line isn't budging. Unlike what you see there at the bottom right at the Bank of Japan, where the reserves, as publicly announced, are skyrocketing. So that's kind of the macro picture. I think what I'd like to do now is turn it back to Moni, who will share with you exactly what our consulting firm's corporate clients are telling us is what's going on there. So if we go to the next slide, Moni will share with us some of our survey highlights.
Thanks, Tony. So as Tony said, we want to share our highlights from our survey. We do go out twice a year to our clients via our LinkedIn groups with a short survey, maybe 5 or 6 questions regarding current and planned practices and expected changes with regard to cash balances. So in the following slides, beginning with the slide that we're on actually, we'll review those findings with you. So on this first slide, we see that expected increases and decreases in corporate cash levels have really leveled out in recent years, with these and other numbers reflecting a moderation in cash level growth. The last significant change occurred between 2011 and 2012. You'll see when the percentage of respondents expecting cash levels to decline dropped from 31% in December 2011 to 18% in December 2012. 50% are now expecting balances to remain largely the same, with slightly more of the other 50% expecting cash levels to increase rather than decrease. Tony will note when he reviews the game changers that there appears to be a renewed level of cash bashing, which we find perplexing, as there's been a moderation in the growth of cash levels reflected in these numbers and others. So we'll be exploring again, either today or in the future, all the reasons behind why cash balances are increasing and why there is the cash bashing. One reason in the past was just that insurance, particularly after 2008, companies were keeping higher balances as insurance against tight external liquidity or expected access to liquidity. We don't really see this as the driving force anymore. We would argue that all the new players in the small business lending external access to liquidity has never been greater. So are corporates simply hoarding cash as accused? We certainly don't believe that, but we'll be interested in hearing what Tony has to say, and also if you all have any thoughts about what's going on there, that would be interesting. So if you can go to the next slide. So in terms of sources of corporate cash, on this slide we see that cash flow from operations drop as a source of cash. This seems somewhat contrary to the positive economic trends, certainly in the U.S., that have been reported in recent months. However, it also reflects a trend showing a decline since 2011 when positive cash flow from ops was noted as a source of cash by 81% of respondents, and in fact was close to 100% of respondents in earlier surveys. Again, we're not sure what's behind this trend, but one hypothesis may be that companies are spending more on an ongoing basis for process and system organization efficiencies as they continue to gear themselves for the new economic environment. You know, where efficiency, transparency, visibility, timely access to data, and controls, including tighter cyber attack controls, are critical for surviving and thriving in the current environment. On the next slide, with uses of cash, here we see really modest changes, with negative cash flow from operations increasing a bit as a use of funds, while there was a decline in all other categories. So I think this chart largely is aligned with the sources of cash. And let's look at the next slide when we look at managing risk. So if you look at maturity and what the respondents said they were going to do around shorter or longer maturity, companies are relatively comfortable where they are regarding maturities. They've already extended maturities in the last 6 months, with fewer expecting to extend them in the next 6 months. In terms of FX hedging, the trend is up in the next 6 months, and perhaps that's a reflection of increased trade or expected increases in trade. And then finally, credit risk. I think this chart really says companies have already made the changes they want to make and are comfortable with the status quo. So there's really reduced need to be more conservative on the credit risk side. Now let's look at changes to Treasury management practices. And this chart really reflects what we see with our clients, an ongoing focus on forecasting, Treasury technology, and monitoring of or modification of policies as appropriate. The Treasurer's and Treasury's role is more critical than ever before, requiring ongoing attention to and investment in these focus areas. And speaking with many of our clients, forecasting remains probably the area of biggest frustration, trying to get it right, trying to make it actionable. And technology optimization continues to be a major focus for all of our clients. Now let's take a look at what we've selected a few quotes from some of our clients that are relevant to maintenance of cash levels or current regulatory environment. So if you look at these quotes on this page, we've selected a few from the survey or direct conversations with our clients or LinkedIn conversations that reflect some of the current concerns from corporates regarding cash balances, investments, et cetera. And these quotes, as you look at them, reflect a continued awareness of what is driving generally higher cash levels. So you see the quote in the upper left-hand corner talking about reduced expenses. So that's actually helped push cash balances up as they focused on reducing their expenses. And then you see concern about the impact of money market funds regulations for investments and investment strategies, so looking at what the alternatives are, not liking the thought of putting money into VNAV, so looking at alternatives. And then we hear from quite a few of our clients that there's great frustration around the number of regulations they need to consider without the time to consider them. So they know they're important, but their biggest concern is how do they get their arms around those regulations? What is it they need to be doing, and what are the best practices around what some of their peers are doing to address the regulations? And then there's a range of perspectives regarding the impact of the liquidity coverage ratio in Basel III on bank relationships. So one client that says, you know, if our bank asks us to move our balances or to reduce our balances or starts charging us for our balances, we'll just move our business. To another one who's really gotten their arms around what it's going to mean and clearly has balances that the bank is questioning in terms of whether or not they're operational. So they've spent quite a bit of time with their bank educating them on why their balances should be perceived as operational balances. So very interesting perspectives. So now Tony's going to review with you the game changers that we're seeing and the potential impact on cash levels.
Thank you, Moni. We have 5 game changers we're going to be discussing today. On the next chart, we can see 5. Clearly, the plunging price of oil conceivably leads to repricing many other tradable assets and the currencies that support them, and that clearly impacts short-term investing. We're going to be discussing that with our panel. The euro and dollar historically have, at least within the last couple of years, have been relatively stable in terms of trading within a relatively narrow exchange rate band. That is completely disconnected, and that has major consequences for all investing, obviously, and hedging. And today we're going to focus on some of the short-term investing aspects. The LCR implementation, the liquidity coverage ratio plank of Basel III is requiring banks to define and treat operational deposits from their corporate clients different from the non-operational or more stable or locked-in deposits, and that has a number of implications in terms of the products that the banks and non-banks will be offering in response to that, as well as financial institutions' appetite to hold deposits or not. We have some interesting conversation about that. Moving over to the far left, we have Grexit, and sure enough, certain problems just never go away. This time around, though, with the possibility of Greece leaving the euro, the macro environment is much different. Banks are much better capitalized. The economies are a little bit more stable. things aren't quite as panicky as they were a few years ago. So the notion of Greece leaving the euro, I think, takes on a different complexion this time around. There will be elections at the end of the month. The opposition government, we believe, is intent on leaving the euro, the opposition party, although the polls in Greece say that the Greeks, as a population, would prefer staying in the euro. So it's not clear, if the opposition party wins, I think we're going to have some turmoil there. If the opposition party loses, we're probably back to the status quo. But our panel is going to have some great insights on that. The final game changers is something I would like to address here, a new round of cash bashing. For those of you who have been following our quarterly cash briefings, now going into our fourth year, you know that we started these briefings to basically defend corporate treasurers and the rational behavior of holding cash on the balance sheet amidst great uncertainty about the future economic environment and about their access to liquidity. It makes perfect sense to hold cash. Regulators and politicians from around the world were bashing corporate treasurers. That seems to have silenced over the last couple of years, but I want to draw your attention to an article that was published on December 12th by the Center for Economic Policy Research in London, called Corporate Cash and Employment. As a student of Niccolo Machiavelli, I look at these things and I ask, okay, so who put this out there, and why are they doing this, and what is this trying to lay the groundwork for? What's actually going on here? This one caught our attention at Treasury Strategies. We scan this stuff all the time to help our clients in their treasury management. This caught our attention because it just simply didn't make any sense. And if something gets published that doesn't make any sense, we ask why, who's behind this, what's going on. This particular study asserts that there is a trade-off between corporate cash levels held by corporate treasurers and CFOs and the wages and employment levels of their organizations. And they actually set this up as if that's how corporate treasurers made decisions. It's like I either increase my cash levels, or I hire people, or decrease my cash levels and fire people. They're confusing a balance sheet item, levels of corporate cash, and they're confusing that balance sheet item with an income statement item, which is salary and benefits, wages. That's not how corporate treasurers make decisions. Now, if that's where it's ended, we can say, okay, that's just red herring. But they go on then to say, or to allude, that high levels of corporate cash in the U.S. Are driven by poor U.S. tax policy. So it's the repatriation and all of those issues that cause U.S. corporations to have to hold a lot of cash, and therefore their behavior is rational, implying then that in other jurisdictions the behavior is not rational. It's the other jurisdictions where the big bad corporate treasurer decides to fire employees because they want to raise cash or whatever. And without crying wolf, the concern that raises for us at Treasury Strategies is, up until now, financial regulation has been focused on regulating financial institutions, and corporate treasurers have to deal with the knock-on effects of that. There are very few regulations, sort of like derivative collateral and things like that actually impact a corporation or directed at a corporation specifically. We suspect that this may be the first plank in a platform that will provide the rationale for European regulators to begin targeting corporate balance sheets directly. Again, we don't want to be overly alarmist about this, but this is something that Treasury Strategies is going to be watching and working very hard to put an end to before these arguments get any traction. So that's my rant for the day. it's something that concerns us because if you read the article, it starts with a fallacious assumption and then proceeds to use bad logic to make it even worse. And we don't like that. Let's go on. At this point, we have the other four game changers. Moni, could you introduce our panel, and then we can begin the discussions on the oil, the euro-dollar disconnect, the LCR implementation, and Grexit.
Sure, Tony. Sounds like an exciting panel. So I would like to introduce you to our distinguished panel. We have Peter Matza from the Association of Corporate Treasurers. He joined the ACT in September 2006 after 25 years in banking and corporate treasury. He was appointed head of publishing in May 2008 and engagement director in February 2012. He is currently responsible for developing strategy to widen the ACT's engagement with the global treasury community, as well as managing the publications business of the ACT. For most of you, I think, are aware that the ACT is a professional treasury organization headquartered in the UK, but with members globally and delivering international qualifications globally. Debbie Cunningham is Executive Vice President and Senior Portfolio Manager and Chief Investment Officer for Taxable Money Markets at Federated Investors, a leading investment management firm and pioneer in money market and fixed income funds. And then Roger Merritt is a Managing Director at Fitch Ratings in New York, a leading global provider of ratings, commentary, and research. Roger is responsible globally for ratings on funds and asset managers. So Tony, I'm going to turn it over to you to facilitate the panel. Have we lost Tony? Hello?
Oh, hello. Well, let's move on to the next slide and see the smiling faces of all of our panelists there. We'd like to begin with a question to Peter Matza. The Association of Corporate Treasurers, as you know, is a global organization headquartered out of London and comprised of treasurers from around the world. Peter, this summer, the ACT talked to its members about the sources and uses of corporate cash and the trends. Could you just take a minute or two to sort of put some finer points on what we just heard from Moni?
Sure. Thank you, Tony, and good afternoon from London, everyone. You obviously raised earlier in one of your slides the level of cash held on UK corporate balance sheets of around half a trillion sterling and around 2 trillion sterling in a European-wide context. What we found when talking to corporate treasurers, our members and others during late summer and early autumn last year was that corporates, recognizing the cash positions that they had, were beginning to formulate plans to spend some of that cash in a variety of ways, whether through their supply chain, whether through further investment, whether potentially through M&A or some other form of corporate expansion, but that they would nonetheless expect after that to still hold higher balances than might have been the case previously over 5, 10, or 15 years worth of experience. To the extent that there are numbers on that, about 3/4 of those we talked to were planning on making use of that cash, but only just under half, or rather just under half, were going to hold those higher balances that I just talked about. Most of them felt that they weren't going to be spending that cash aggressively. Perhaps less than a fifth were going to be doing so through things such as returning funds through to shareholders through dividends or through buybacks of one form or another, or not replacing maturing debt and so on, or paying down maturing debt, for example. But I think what our overall position was, and it reinforces to an extent what you were saying, but also disagrees with you slightly, was that corporate treasurers are still in the throes of relative uncertainty. I say relative uncertainty because it's less an issue of direct volatility, but rather having experienced the inability of the markets, whether cash or bond markets, to be there when needed. Treasurers, by nature cautious, are sitting on money to say, we don't trust the world, we don't like the way the world looks, and we're not prepared to take a chance that the world's going to smile at us if we spend all of this money. In particular, we're also concerned, certainly from a UK and to an extent a European perspective, that managing that liquidity sensibly and effectively will become more challenging because there are going to be structural changes in banking, certainly in the UK with Vickers and potentially in Europe with Liikanen, in terms of the organisations that we can hold money with. Money market funds, of course, are looked at potentially differently from a European perspective from the US in terms of things like their ratings positions. We, on the other hand, for example, though, are not too fussed about the VNAV idea. What we are really concerned about are the issues of the gate fees and capital requirements being put into funds, which clearly is going to be a no-no for most of our users. I note in one of your comments, one of your clients was talking about, well, we're going to invest in repos, but we'll only go into US Treasuries and UK gilts. The problem that we have is that we're competing in a marketplace where the OECD says you can invest in any OECD bonds and they all count as zero risk weighted, and corporates are anything from 50 to 100% risk weighted. That's a problem that we've got to deal with in terms of where we can get access. But I think in general, we're still seeing a considerable level of prudence. We're seeing, as I say, some planned increases in spend across a range of areas, but I think the levels at which people are going to retain cash are still reflecting economic and political uncertainty, whether Grexit or Brexit, if you look at it from the British point of view, whether it's to do with geopolitical concerns, Ukraine, for example, which are much more direct for us here in the UK and in continental Europe. I think that's the reason that we're looking at prudence from our members.
Thank you, Peter. That was an excellent recap, and it doesn't sound like corporations are going to be taking all of that cash off their balance sheet and plowing it back into the regular economies very soon. Let's move on with the game changers and start with a question for Roger Merritt from Fitch Ratings. So we have the collapse in oil prices in recent months, which has resulted in a massive repricing of global dollar-denominated assets. Roger, from Fitch's perspective, what are the credit rating implications of that?
Thanks, Tony, and hello everyone on the call. Yeah, clearly, Tony, you can't have a massive and sharp decline in a global commodity like oil, which is dollar denominated, without there being ramifications and fallout in various areas. Fitch has identified three broad areas that we think bear watching, and because they may very well be impacted. Clearly the first is any sovereign with a heavy fiscal reliance on oil exports to generate revenue, and combined with low levels of foreign reserves, i.e., a very low cash cushion to ride out the storm, is an area of risk. Another sort of clear at-risk sector is the oil and gas sector. We put it on negative outlook the latter part of last year, and we're particularly focused on and concerned about companies that focus on exploration and production. And this reflects the divergence between our base case assumption about oil prices, which had been around an assumption of $75 to $80 a barrel over the intermediate term, and we had a stress case of oil being in the range of $50 to $55. So clearly, as of right now, we are closer to the stress case than we are the base case. So it's going to be interesting to see where prices stabilize over the longer term. And then I think the last area that we've commented on is the banking sector. So there will be some institutions, whether they're domiciled in some of the at-risk countries that I mentioned previously, or those that have just taken outsized exposures to the oil and gas sector in their lending books. We think that's a potential area of risk.
Excellent, Roger. Now, you're looking at this from a credit rating perspective. Let's turn to Debbie Cunningham at Federated Investors, who has a couple $100 billion that she manages and is making actual day-to-day decisions based on these factors. So Debbie, the collapse in the price of oil, has that changed the way you run any of your portfolios, or has it changed any of the names that you're holding in your portfolio?
Thanks, Tony, and Happy New Year to everyone on the call. It really hasn't, and it really goes back to the requirements for issuers that are used within a money market fund. They need to be, the highest quality issuers that are out there representing minimal credit risk in all instances. And certainly the sectors that were mentioned by Roger, the sovereigns, the oil and gas sector, banking, we obviously have exposure to all of those sectors. However, the ones that we're exposed to and the issuers that we're using out of those sovereigns or sectors are the highest quality out there. And again, referencing Roger's base and stress test price scenarios, it's funny when you think back into the last oil and gas crisis, which was probably in the late 1980s, we were stressing stressing oil prices down to about $10 a barrel. So obviously things have changed quite a bit over the course of the last 3 decades. However, I think the stress and the base tests are still relevant, and effectively it comes down to the cost of bringing energy into the marketplace. And in some instances, I think there will be cutbacks because, some of the more complicated techniques cost a little bit more. Obviously, it's made us, from a U.S. perspective, a much less energy-dependent country, which is a wonderful thing. Having said that, if there is any aspect of profitability or loss of profitability that would be sacrificed because of the change in prices, I think those will quickly be shut down. Those ones that are a lot more expensive to extract and produce. So we're following it. It is definitely a credit story from our perspective, but it's one that doesn't impact us to the same degree, I think, that it does some of the lower quality buyers in the marketplace. On the economic side of the equation, we're actually looking at this as a positive, and it's a positive not just for the U.S., but for Europe and others, where we think a kickstart might be a helpful item, whereby disposable income from a consumer perspective, because of the lower prices of energy, should be a very big positive in the 2015 time frame for sort of economic assessment. So we're looking at it in that way. Haven't really seen it flow through yet, but are thinking that will be a later in 2015 item to address.
Very good. So essentially, the names and the regions that are most at risk here from plunging oil price were essentially names and regions that weren't in your portfolio in the first place.
Exactly.
Great. Peter, thousands of members in the ACT, you must be getting quite an earful about the plunging oil prices.
It's an interesting one, that. I'll give you a couple of examples. We know the treasurer of one of the largest Middle East airlines, one of the new Middle East airlines on the block, and up until about the middle or early autumn, or fall as you call it, of last year, they were comfortably the largest hedgers of airline fuel in the marketplace across the whole globe of airlines, and they very publicly came out and said, no, we've stopped because of the relative uncertainty. They don't quite know what it means. I'm not as convinced that it bothers as many people, unless it's a direct impact on you. If you're in the transportation business, for example, where your costs may well be going down, for example, and clearly for an airline that has an impact on them. Although if you're hedged in at $85 or $90 a barrel, it maybe isn't of any great use to you, depending on whether you can flex your schedules and your passenger numbers and so on. I think in a more broad context, where it knocks into perhaps some of the foreign exchange volatility issues, certainly if you look at it from a sterling point of view, value, I'm losing ground against the dollar, but I'm gaining ground against the euro. So depending upon, given the fact that my European partner is my larger trading partner, but that my dollar flows may be more important to me depending upon what industry I'm in, I think it's one of those where you have to take each one on the particular circumstances. It's not specifically one that we've had people coming to us to talk about. I think it's the foreign exchange impact perhaps that may have more value, and of course as a treasurer you have to worry about the direct impact through transactions, but you also have to worry about the backdoor impacts of things like translation and even economic exposure. Does it benefit your competitors, for example, but you're not noticing it? I think those are the things that treasurers think about, rather than perhaps the obvious headline figures of prices, unless, as I say, it's something specific in your particular industry.
Well, those are great insights. In fact, that's a great segue into the next game changer of the euro-dollar disconnect, because obviously with the asset prices shifting, current currencies and the value of the currencies is how that gets transmitted. So, Roger, at Fitch, we've seen a decline in the euro appreciably over the last year. How do you at Fitch see this impacting cash and treasury management?
Yeah, sure. Thanks, Tony. Yeah, I mean, I think at the outset, I think it's important to keep in mind that, yes, we've seen, let's call it a 20% decline over the last year in the euro relative to the dollar. But, we've been here before. I actually went back and looked at dollar-euro exchange rates over the last decade, and, we saw actually deeper and sharper declines in 2008 during the financial crisis and more recently in 2010. So I think it's important to keep that in perspective. And I think, at the end of the day, it clearly says something about the relative economic trajectories of the U.S. versus Europe. I think there's a view that the U.S. may be finally, gaining some velocity in terms of economic growth, and rates are expected to go up sometime this year, albeit I think maybe later in the year than some people thought. Whereas Europe is clearly struggling in terms of negative yields, continued concerns about falling into a deflationary cycle. So what we're seeing in the exchange rates is a reflection of what's happening in the fundamental underlying economies. In terms of treasury management, I think the thing that we've talked about internally the most is there are companies that have significant amounts of what we'll call trapped cash in Europe, and yet they continue to fund their U.S. dollar operations through borrowing. So on a consolidated basis, leverage looks very low. But when you deconsolidate and look at leverage by functional currency, and strip away what we'll call the trapped cash, the cash sitting overseas that companies are reluctant to repatriate due to primarily tax reasons, the leverage ratios look much higher. So if you then add on another 20% haircut for currency exposures, the leverage ratios are only going to look worse. We did a report on this recently. We tried to identify companies where there was an appreciable divergence between their reported or net leverage and then gross leverage based on the U.S. entity. And just throwing out one example, we had a company that had $20 billion of cash and short-term investments on its balance sheet, but it turns out 90% of that cash was overseas, and we thought unlikely to be repatriated unless they absolutely had to. And so while they reported leverage ratios of around 2.8 times on a consolidated basis, when you looked at gross leverage, it was closer to 7 times. So I think that's one of the areas that we're focused on in terms of the companies that we look at.
Well, it sounds like something you're going to need to keep your eye on. And again, Debbie, this impacts your day-to-day investing. How does this disconnect impact what you do?
Well, obviously, the reason the exchange rates have gone in the direction they have is because the U.S. is growing faster than Europe at this point. You know, this is a mechanism that should help Europe in their competitiveness with regard to, you know, their ability to export their products and, you know, sort of the cost of goods produced, that sort of thing. So, you know, I guess we're looking at it as something, again, you know, into further down into 2015 as something that, you know, maybe lifts Europe out of, you know, sort of its steady growth, you know, or it's even, staying even, you know, where a few countries have increased and a few countries have decreased, and, you know, by and large, the overall Eurozone has been about as flat as you could be. So we're looking at this as something that, you know, potentially might kickstart that a little bit, but certainly it's got some lead time associated with it.
Thank you. Now, Peter, let's move on to Basel III and the liquidity coverage ratio implementation, which changes the way banks look at their corporate customers' deposits. How is that impacting your members?
I could be polite and give you a sensible answer, but I'd probably be easier if I just said the whole thing looks like a mess at the moment to us. I don't think there's a great deal.
I love that.
Yeah, I don't think there's a great deal of clarity. We certainly know that some of the major institutions are clearly looking to try and find ways in which they can encourage people to give them long-term cash, and there may be value in that for people if, as we've talked before, they have higher levels or higher continuing levels of cash on their balance sheets. They need to do something with it. The repo market clearly isn't going to offer them any particular value other than perhaps security. That's an arguable point too. I think it generally goes into the pot of no one's quite sure with bank regulation, and obviously in the UK and in the European context, as I mentioned already, when you throw in over the next 2 or 3 years the potential for all sorts of ring fencing or breakup or whatever you want to call it in terms of how banks are structured, there are all sorts of arguments. For example, just in the UK context, you could be an awful lot safer off outside of ring fencing as a corporate than inside it. What most particularly bothers us, of course, is the fact that if you have cash in a bank and the bank goes down, bail-in now means I'm actually a creditor, or rather, I'm an investor, in that bank, but I don't have any rights. Shareholders have rights to vote. They can vote for management. They can do all sorts of things. I don't. My money goes downhill pretty quickly with the bank. So I think it's part of that wider regulatory context rather than the specifics of what to do with the cash, albeit that a good treasurer is clearly worrying about that on a daily and an operational basis.
Well, and I think all 4 of our organizations, Treasury Strategies, Federated, Fitch, and ACT, are hearing pretty much the same thing, that there is a lot of confusion and lack of clarity. As we're bumping up against time, I'd like to move on to Grexit and get each of yours quick take on the possibility of Greece leaving the Eurozone and the consequences should that happen. So Debbie, why don't you start this round? What's your take on all of this?
We're still in the camp that we've been in the last I guess this is round 3, the last 2 times that, you know, this has been in the news as a high potential, and that is we're in disagreement with that. We don't think the likelihood is very high that Greece will in fact exit the euro, and think that the consequences and the implications for the Greek population and the country itself would be dire enough that's just not something that they're going to undertake lightly. So we're in the low probability camp for the actual event taking place. If in fact it did take place, obviously there's a whole lot of fallout, not only from Greece. I mean, obviously we know some of the instances there, but then to some of the other more marginal players or lesser players in the Eurozone as to whether or not they'll continue also, or whether this will, prompt a little bit more of a concentrated effort for other countries to actually exit. Again, that even a lower probability than the Greece side of the equation, but for the most part, it is, again, the countries that, as a money fund provider, we are not dealing with anyways. However, the implications to, the broader European community and the Eurozone in particular would be felt across all, from the highest quality in Greece and France, down to the lower quality entities. So again, low probability, but big impact if it actually happened.
Interesting. Low probability, high consequences. So, Peter, do you see that the same way?
To an extent, I'd probably agree with that. I don't think we particularly have a view on that. I think we would expect treasurers in the event of an exit of any one of those countries to already be prepared. I think this ground's already been gone over, as Debbie's already said. Personally, I think this is more of a political issue, less of an economic one, and I don't think there's any obvious waterfall effect at the moment. You can't see it in the case of Ireland or Portugal, or even in Spain to an extent. So I think it's a political issue. Of course, I'm sitting in the UK. We have a general election coming up in May, and we don't know whether that's going to be an issue coming up post that election too. But that's one we can throw under the carpet for the time being. I don't think generally speaking we're seeing people too worried. And I'd probably take Debbie's point of view. If you have business with Greece, you've probably got your BDI on it all of the time, just in case, and you know what you're going to do. The only other thing I'd say, of course, if I'm the corporate treasurer of a Greek organisation that deals in hard currency, I'm probably not fussed one way or the other, frankly. And if I own a hotel and I've got German tourists coming, I'm still very happy as long as the sun shines.
Well, what a great outlook. Roger, how about a last word?
No, I agree with most of what Debbie and Peter said. I'm reminded of the adage, beware Greeks bearing gifts. I think certainly in terms of our rating outlook, the Greek story has been in the news for quite some time, and I also share your view, Tony, that if there were an exit from the Eurozone by Greece, I think the contagion effects would be much less than the last time around, given how much the banking sector has been able to strengthen itself.
Thank you, Debbie, Peter, Roger. That was a lot of food for thought on this cold winter day, at least here in the northern part of North America. Let's turn it back to Moni to recap and tell us where we go from here.
Okay, thanks, Tony. That was a great panel. So we thank everybody on the line for joining our 14th quarterly cash briefing, and a special thanks to Debbie, Peter, and Roger. Again, that was a fascinating discussion. Look for our invitation on the briefing next quarter, and when we send you the link to today's recording, you will have the opportunity to sign up for our next 3 cash briefings, so please sign up. Also, for the corporates on the line, be on the lookout for our next survey in 6 months and take a few minutes to respond. Thank you, too, for your questions. We'll answer and circulate to all who registered, and we'll also send you a copy of the report. We encourage you to look at our sponsors' websites and on our website for further articles and commentary, and to reach out to us if we can help you with your liquidity forecasting technology strategies as you navigate these uncertain times. Thank you.